Banks told crypto companies, play by our rules. Ripple applied for a national bank charter to play by their rules. The same banks then wrote letters telling regulators to block the application. That contradiction is not a mistake, it is the strategy. And today, we decode exactly what it means for the Clarity Act and for XRP. The American Bankers Association has spent the last 18 months arguing that crypto companies should be subject to bank-level regulation if they want to offer bank-like products. The argument sounds reasonable. If you want to operate like a bank, comply like a bank. Ripple took that argument seriously. Ripple applied for a national bank charter through the Office of the Comptroller of the Currency, the precise regulatory pathway that bank-level compliance requires. The ABA's response was to write a formal letter to the OC asking regulators to pause and delay approval of Ripple's application, along with applications from Circle and Coinbase, until Congress finishes implementing crypto rules that the ABA is simultaneously lobbying to slow down. The same organization that demanded crypto companies comply with bank rules is now blocking the regulatory process that would make that compliance possible. That is not a policy position. That is a documented contradiction, and it tells you everything you need to know about what this fight is actually about. Today, we decode the ABA strategy, the Clarity Act's real status, the SEC-CFTC agreement that changes the regulatory timeline, and why the White House just publicly attacked the banking lobby on the stablecoin yield question. Let's get into it. Welcome back to Crypto Report. We read the regulatory architecture behind the lobbying headline. Today, we decode the ABA's documented contradiction on crypto bank charters, the stablecoin yield debate that is the real battlefield underneath the Clarity Act, the SEC-CFTC Memorandum of Understanding that eliminates the biggest institutional deployment delay, and the White House response that confirms which side of this fight the executive branch has chosen. Here is the structural argument the ABA is making and the precise point where the data exposes it as protectionism rather than principle. The ABA's stated concern is deposit flight. Their argument if stablecoin issuers are permitted to offer yield or rewards on stablecoin balances currently ranging from 2 to 4% on platforms like Coinbase and Circle. Depositors will move money out of traditional bank accounts and into stablecoins to capture that yield. Treasury Secretary Bessent has projected the stablecoin market reaching $3 trillion by 2030. The ABA calculates that $2.7 trillion flowing into stablecoins would remove approximately $2.22 trillion from the bank lending base, reducing available capital for small business loans, agricultural lending, and residential mortgages. That concern taken in isolation is a legitimate policy question. Large-scale deposit migration does carry systemic risk implications for the fractional reserve banking system. The question is whether the ABA's response to that concern is proportionate or whether it reveals a different motive. Here is the data point that answers that question. MasterCard's Crypto Rewards program, which currently enables partners, including Gemini, to offer up to 4% back-end crypto on everyday spending categories, and Meta MasterCard to offer 1 to 3% crypto rewards on all purchases, operates through fully regulated banking partners, runs on traditional payment rails, and effectively provides yield-equivalent benefits on consumer spending at the same or higher rates than the stablecoin yields the ABA is lobbying to ban. The ABA has issued no public statement opposing MasterCard's crypto rewards infrastructure. No joint letters, no congressional testimony framing 4% crypto cash back through MasterCard as an existential threat to bank deposit stability. The same mechanics, consumer assets earning crypto-denominated returns, are acceptable when they flow through MasterCard's traditional rails and unacceptable when they flow through crypto-native stablecoin infrastructure. That asymmetry has one explanation. This is not a principled concern about deposit flight. It is a competitive moat defense protecting incumbent banking infrastructure from decentralized alternatives that eliminate the intermediary layer that bank fee revenue depends on. White House crypto advisor Patrick Wicks stated it directly at this week's conference. Crypto has been offering stable coin yield for years. The deposit flight the ABA is warning about has not materialized. The warning is not a prediction. It is a lobbying instrument. Let's put the stablecoin deposit flight argument against the actual data because the numbers make the ABA's position structurally indefensible. The current U.S. stablecoin market is approximately $300 billion. The ABA is modeling catastrophic deposit flight on the projection that this market reaches $3 trillion by 2030, a 10x expansion over 4 years. That growth projection comes directly from Treasury Secretary Bessent's own forecast. which means the U.S. Treasury, the institution that manages the national debt, is projecting and actively supporting a 10x expansion of the stablecoin market. Here is why Treasury is supporting it. The United States currently issues significant volumes of Treasury bonds and requires buyers to finance ongoing deficit spending. Stablecoin issuers, to maintain their dollar peg, are required to hold reserves in U.S. Treasury instruments. A $3 trillion stablecoin market means $3 trillion in mandatory Treasury purchases by stablecoin issuers. That is $3 trillion in new demand for U.S. government debt from a buyer class that did not exist 5 years ago. The ABA is lobbying against the regulatory framework that would enable the instrument that the U.S. Treasury needs to fund its own debt obligations. The White House is aware of this arithmetic. That is why Patrick Wick's public response to the ABA's deposit flight argument was not diplomatic. It was direct. And it is why the executive branch has consistently pushed both the Genius Act, now passed, and the Clarity Act forward. Despite sustained banking lobby opposition, RLUSD, Ripple's institutional stablecoin, operates within precisely this architecture. Dollar-pegged, backed by U.S. Treasury instruments with BNYM Mellon custody infrastructure. Every dollar flowing into RLUSD is a dollar purchasing U.S. government debt. The ABA's opposition to RLUSD's regulatory pathway is opposition to an instrument that benefits U.S. fiscal mechanics. That position is not sustainable at the executive branch level, and the White House's public posture confirms it. And this is the fiscal architecture: stablecoin reserve mechanics, Treasury demand, executive branch positioning, and the ABA's documented contradictions on bank charters that Crypto Report maps every week, while the market reads the lobbying headline and misses the structural incentive underneath it. The ABA blocked Ripple's bank charter application while demanding Ripple comply with bank rules. The White House publicly attacked the ABA's deposit flight argument. The Treasury needs stablecoin buyers for its own debt, and the SEC and CFTC signed a cooperation agreement that eliminates the biggest institutional deployment bottleneck. If this regulatory architecture is showing you why the Clarity Act passes despite banking lobby opposition, subscribe to Crypto Report right now and hit the notification bell. The Clarity Act summer legislative window, the OC charter timeline, and the stablecoin yield compromise are all developing simultaneously. I track every structural signal with this precision every single week. Subscribe now. The hand has been shown. The math explains everything. Let me show you the institutional signal that makes the Clarity Act's passage structurally inevitable, regardless of the ABA's lobbying velocity. This week, SEC Chairman Atkins and CFTC Chairman Pham signed a memorandum of understanding establishing formal coordination between both agencies, shared information protocols, joint product reviews, elimination of duplicative regulatory requirements, and a specific framework for substituted compliance that allows products to satisfy both agencies' requirements through a single approval pathway. The strategic significance of this MOU for institutional deployment is precise. In every previous crypto regulatory clarity event, the gap between legislative passage and institutional activation was measured in months because compliance teams at major financial institutions were waiting for the regulatory agencies to operationalize the new framework before committing capital. The SEC and CFTC were historically in jurisdictional competition over crypto asset classification, a turf war that created regulatory ambiguity that compliance teams could not navigate. The MOU eliminates that ambiguity before the Clarity Act passes. When the Clarity Act reaches the President's desk, both agencies will already have joint review protocols, shared information frameworks, and coordinated compliance pathways operational. The institutional green light will activate on the day of passage, not 6 months after it, for the $3 to $5 trillion institutional capital pipeline that has been building compliance infrastructure during the regulatory wait-and-see period. That timing compression is the difference between a gradual inflow and a simultaneous activation event. Here's the specific forward calendar that the ABA lobbying battle and SEC-CFTC MOU are building toward. Genius Act passed. Stablecoin regulatory framework is law. RLUSD's compliance pathway is confirmed. The foundational stablecoin architecture that powers ODL corridors and institutional XRP settlement is legally operational. OC National Bank Charter timeline contested by ABA but advancing. Ripple's application is on record. The OC's mandate is to evaluate applications on documented criteria, not on banking lobby preference timelines. The ABA's letter requesting delay is on record. So is the White House's documented opposition to banking lobby interference with crypto regulatory processes. Clarity Act Summer 2026 legislative window. SEC-CFTC MOU is the operational preparation. Both agencies are already coordinating. The institutional capital waiting for this gate to open is documented in ETF inflow data, Bank of America's 4% allocation recommendation, and Franklin Templeton's universal liquidity layer positioning. The ABA showed its hand, the White House showed its response. The regulatory machinery is already moving. Let me leave you with the contradiction that closes the debate. The American Bankers Association told crypto companies to comply with bank rules. Ripple applied for a national bank charter to comply with bank rules. The ABA wrote letters asking regulators to block that application. The ABA then warned that stablecoin yields would trigger deposit flight. Patrick Wick pointed out that stablecoin yields have existed for years and deposit flight has not materialized. The ABA said nothing about MasterCard's 4% crypto rewards program running through traditional banking rails. One organization, 3 documented contradictions, 1 consistent through line, blocking decentralized infrastructure from the regulatory access that would make it a legitimate competitor to incumbent banking rails. The White House has chosen a side. The Treasury's fiscal mechanics require stable coin growth. The SEC and CFTC have ended their turf war. The Clarity Act summer window is confirmed, and Ripple's bank charter application, the application the ABA tried to block, is still on the OC's active docket. The ABA showed its hand. The hand confirms the thesis. An institutional capital guided by the White House's documented position and the Treasury's fiscal arithmetic is not going to let a lobbying letter determine the outcome. Price is a distraction. The regulatory architecture is the reality, and the math, when you follow it through the fall, fiscal and legislative chain, does not lie. I am Crypto Report. The hand has been shown. Now you know what game is being played.